All right, seeing here, we've got some exceptions to discharge and payment priorities. Now, the relationship between exceptions to discharge and payment priorities is going to be crucial in understanding how certain debts are treated during the bankruptcy process. Priority rules determine the order in which debts are paid from the debtor's estate, which we just saw in our previous example, while exceptions to discharge determine which debts cannot be eliminated even after bankruptcy. Now, some debts may be both a priority and an exception, while others may be either a priority or an exception. Now, regardless of whether a debt is accepted from discharge, the distribution of the debtor's estate follows the priority rules that we saw. After all possible payments have been made according to the priority rules, any remaining debts are discharged except for those that are exceptions to discharge. In some cases, a debt that is an exception to discharge may be paid during the distribution process. Right, we saw, for example, student loan debt, you're not getting out of that. For example, consider a scenario where creditors are paid in full through the eighth priority, which includes tax claims. In this case, the fact that a tax claim is an exception to discharge becomes irrelevant because it has been paid in full. That's a priority, exception, boom. However, if payment is made only through the fourth priority claims with the fifth through ninth priorities are discharged except for the unpaid eighth priority tax claims because they are going to be an exception to discharge. All right, some miscellaneous recap, some information, some things we've seen, some things we haven't seen. Just getting a nice overall recap. Got a few more slides and we'll call it a day. Property included in bankruptcy, that's going to be assets, real and personal assets at the time of filing, plus assets received within 180 days, so divorce, inheritance, insurance, income generated such as interest. Exclusions include essential items for living, unless a lien is present. The trustee has priority over everyone except for perfected security interests, statutory liens, or judicial liens. Preferential payments, remember we talked about these. Payments made within 90 days of filing, 1 year if they are an insider, that are more than $600 and not consumer debt, or antecedent debt, which is also, as we saw, that is debt that has already existed, and when the debtor was insolvent, are considered preferential. These payments allow creditors to receive more than they would have in bankruptcy, so it's a big no-no. This rule does not apply if the debt is fully secured, so as the creditor would have received that amount anyway, or for ordinary expenses such as bills, rents, domestic support. Claims made, unsecured creditors must file that proof of claim, and shareholders must file a proof of interest to have a right to payment. If you fail to do this, you will not have any part in the distribution process. All right, nice recap of all our chapters here, chapter 7, 11, and 13. While all three types of bankruptcy provide relief for individuals and businesses who are struggling with debt, hey, who's not struggling with debt these days, there are some important differences between them. Chapter 7, this is our liquidation bankruptcy that is solely Chapter 7, meaning that the debtor's non-exempt assets are sold to pay off creditors. This type of bankruptcy is typically used by individuals with little or no assets and a large amount of unsecured debt, such as credit card debt or medical bills. Now, Chapter 11 bankruptcy is a reorganization bankruptcy primarily used by businesses. It allows businesses to continue operating while restructuring their debt and creating a repayment plan. Then lastly, Chapter 13, that is a reorganization bankruptcy that is designed for individuals with regular income. Now, under Chapter 13, the debtor creates a repayment plan to pay off all or a portion of their debts over a period of 3 to 5 years. One of the main differences between these types of bankruptcy is the way the assets are handled. Now, in Chapter 7, as we saw, assets may be sold to pay off creditors, while in Chapter 11 and 13, debtors are typically able to keep their assets while they repay their debts. Another difference here is the eligibility criteria for each type of bankruptcy. For example, Chapter 7 has income limits, while Chapter 13 requires the debtor to have regular income to create a repayment. Lots of wonderful stuff here. Gotta love bankruptcy. Such a positive, uplifting topic. Thank you all for joining. Let's end it with a nice summary.
Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.